Gold has just smashed through a significant barrier, reaching $3,000 per ounce, just over a year after its previous high of $2,000 in November 2023. While many headlines are fixated on these round numbers, the real story behind gold's surge is far more intricate, reflecting deep-seated shifts in global monetary policies and a growing distrust in traditional financial system. At the heart of this rally are several interlinked factors. One of the primary drivers is the unprecedented fiscal situation the U.S. government found itself in at the close of fiscal year 2024. The government was spending every single dollar of tax revenue on interest payments and mandatory entitlements like Social Security and Medicare. This left no room for discretionary spending, meaning that essential government functions, including military operations and federal courts, had to rely entirely on additional borrowing. This level of fiscal strain has significant implications for the economy and investor confidence. Adding fuel to gold's ascent, foreign central banks have been on a buying spree, steadily increasing their gold reserves while simultaneously reducing their holdings in dollars. Unlike private investors, these institutions view gold not just as a speculative asset, but as a strategic reserve. Their approach to purchasing gold is different. They continue to buy regardless of the price, recognizing gold's enduring value in maintaining financial stability and sovereignty. Meanwhile, the dollar's appeal has been steadily declining. In the 1990s, the United States was the undisputed superpower, running budget surpluses and holding unquestioned monetary authority. However, this position has eroded over time due to a combination of unpopular wars, massive spending programs, and borrowing related to the COVID-19 pandemic, which pushed debt levels to unprecedented heights. This erosion of confidence in U.S. financial leadership has been a critical factor driving investors towards gold. A significant component of this shift is the weaponization of monetary policy. Starting with anti-terror measures after 9/11, the U.S. Treasury expanded its powers to sanction and freeze assets, initially targeting criminal groups. Over time, this authority extended to pressure banks, businesses, and even entire nations. The sanctions imposed on Russia in 2022 were a turning point, leading many countries to seek alternatives to the dollar to avoid being vulnerable to such financial coercion. This move away from dollar dependence has further bolstered gold's appeal as a stable and reliable store of value. Gold stands out among other assets for its unique advantages in storing and transferring large-scale wealth. For example, a barrel-sized container filled with gold can hold approximately $140 million in value. In comparison, the same volume in oil amounts to about $70, and silver holds around $2 million. This immense wealth density makes gold particularly attractive for central banks managing billions in reserves, offering a compact and efficient means of safeguarding wealth. While silver remains important, its performance hasn't kept pace with gold. Currently priced at $34 compared to its 2011 high near $50, silver hasn't matched gold's rise. Although silver has industrial uses and serves as an inflation hedge, its lower wealth density and smaller market size make it less appealing for central bank reserves. Additionally, the silver market is more susceptible to volatility and manipulation due to its limited size, further diminishing its attractiveness compared to gold. Looking ahead, despite reaching the $3,000 mark, there are several indicators that suggest gold's rise is far from over. Central banks show no signs of slowing their gold purchases, and government spending alongside debt levels continues to climb. The absence of serious fiscal reform proposals from U.S. leadership points to an ongoing decline in confidence in the dollar, reinforcing gold's upward trajectory. For investors worried about missing out on this gold move, mining companies present an alternative entry point. Many gold producers are currently undervalued relative to the rising gold prices, offering potential leverage for further gains. Recent trends have shown mining stocks increasing by 20 to 40%, while maintaining strong balance sheets and paying dividends, making them an attractive option for those looking to benefit from gold's rally. However, it's important to recognize that price movements are rarely linear. Investors should be prepared for possible corrections while keeping an eye on longer-term trends. Investing in mining companies comes with additional operational risks compared to holding physical gold, but selecting high-quality producers can offer compelling value at current levels. In conclusion, the gold market is a mirror reflecting broader changes in global monetary relationships. Central banks' search for alternatives to dollar reserves signifies a structural shift rather than a temporary fluctuation. Even though gold prices have surged significantly, the fundamental drivers behind this rise remain strong and are only becoming more entrenched. Smart investors understand that gold's role evolves with market conditions. The current environment, characterized by central bank buying, fiscal stress, and declining confidence in the dollar, creates robust support for precious metals. Whether through physical holdings or shares in quality mining companies, maintaining exposure to the gold sector is a strategy that everyone should be looking at in an increasingly volatile financial climate.